By the late 1970s, the bond market was, in effect, binary. Either investment grade or virtually no access to capital. Companies rated below BBB were simply not treated as systemic borrowers. They were labeled fallen angels or speculative, and that was the end of it. In 1971, a young analyst joins Drexel Burnham Lambert, Michael Milken. He makes an observation the market had largely ignored. Lower-rated bonds do not necessarily produce worse risk-adjusted returns. In fact, quite the opposite. Based on decades of data, defaults occurred more frequently, but yields more than compensated for those losses. The market was not pricing risk correctly. It was simply avoiding it. By the late 1970s, Milken begins actively building the high-yield bond market. At the beginning, the junk bond market was roughly $10 to $15 billion by the mid-1980s. It exceeded $200 billion by 1989. Total issuance reached approximately $300+ billion. Milken was not just analyzing, he was building infrastructure. Direct relationships with institutional investors, a continuous flow of deals, a market where risk became a product, not a defect. Case: KKR and RJR Nabisco. In 1988, one of the most famous leveraged buyouts takes place. KKR acquires RJR Nabisco for $25 billion, a significant portion financed through high-yield bonds. Without Milken, that scale of transaction would not have been possible. Before Milken, capital followed stability. After Milken, capital followed potential plus yield. In 1989, investigations begin. In 1990, Milken pleads guilty to several charges, receives a 10-year sentence, serves approximately 22 months, pays around $600 million in fines and settlements. Drexel Burnham Lambert files for bankruptcy in 1990. Despite the reputation of junk bonds, Milken almost never used that term. Internally at Drexel, they were called high-yield securities. This was not just rebranding, it was a repositioning of risk as an asset class. The market remembers Milken as the man who made risk accessible. But that's not entirely accurate. He made invisible risk, visible and tradable, and that is what changed the system. After Milken, the market did not become safer. It became faster, deeper, and far more dependent on how risk is evaluated. In simple terms, before him, risk was avoided. After him, it was traded.